Hey everyone, and welcome back to the channel. Today, we're rediving deep into the topic that is on everyone's mind. What is happening with Bitcoin's price? We've seen some pretty dramatic swings lately, with a significant drop that has a lot of people feeling nervous, confused, or maybe even a little excited. So, what's really going on behind the scenes? Is this just another Tuesday in the world of crypto, or is there something bigger at play? In this video, we're going to break it all down. We'll look at the key factors driving this recent downturn, analyze the market sentiment, and discuss what historical data can tell us about what might come next. Whether you're a seasoned hodler or just crypto curious, stick around. We're going to cut through the noise and give you a clear, no-nonsense analysis of the situation. Let's get into it. First things first, let's talk about the elephant in the room: macroeconomic factors. You can't look at Bitcoin in a vacuum. It's part of a global financial system, and what happens in the big leagues definitely affects the crypto space. Recently, we've been hearing a lot of talk from central banks around the world, particularly the Federal Reserve in the US. They've been sending strong signals about their plans to tackle inflation. This usually involves raising interest rates. Now, why does that matter for Bitcoin? Well, when interest rates go up, traditional, safer investments like bonds become more attractive. Money tends to flow out of higher-risk assets, and let's be honest, crypto is still seen as a higher-risk, higher-reward play by many institutional investors. So, as the cost of borrowing money increases, there's less cheap money floating around to be invested in assets like Bitcoin. This shift in monetary policy has created a risk-off environment, and we're seeing its impact not just in crypto, but across the stock market as well, especially in tech stocks, which often move in a similar pattern to Bitcoin. It's a classic case of market jitters driven by uncertainty about the economic future. Another huge piece of the puzzle is regulatory news. It feels like every week there's a new headline about a government somewhere either cracking down on or embracing crypto, and this creates a ton of volatility. For example, recent announcements from major economic powers discussing stricter regulations for exchanges or mining operations can send shockwaves through the market. Why? Because regulation introduces uncertainty. Traders and investors hate uncertainty. They don't know how new rules will affect their ability to trade, hold, or profit from their digital assets. On the flip side, positive regulatory news, like a country approving a Bitcoin ETF, can send prices soaring. But lately, the sentiment has been skewed more towards caution. The market is trying to price in the potential impact of these future rules, and that often translates to a sell-off as people decide to take their profits off the table until the dust settles. It's a waiting game, and right now, many are choosing to wait on the sidelines. Now, let's get a bit more technical and look at what's happening on-chain. On-chain data gives us a fascinating look into the behavior of Bitcoin holders. One metric we always watch is the flow of Bitcoin to and from exchanges. In the lead-up to this recent drop, we observed a significant increase in the amount of Bitcoin being sent to major exchanges. Typically, when long-term holders move their coins to an exchange, it's often with the intention to sell. This creates increased selling pressure. We saw whales, those large wallets holding thousands of Bitcoin, making some big moves. When a whale decides to sell, their sheer volume can trigger a cascade effect. It spooks smaller investors, leading to panic selling, which then drives the price down even further. It's a domino effect. We also need to look at the derivatives market. The futures and options markets can have a huge influence on the spot price. A large number of liquidated long positions, where traders betting on a price increase are forced to sell, can accelerate a downturn dramatically. This is exactly what we saw: massive cascade of liquidations that poured fuel on the fire of the price drop. So, we've talked about the macro environment, regulation, and the on-chain data. But what about the human element? Market sentiment. Never underestimate the power of fear and greed. The Crypto Fear and Greed Index, a popular tool that measures market sentiment, has been hovering in the extreme fear zone for a while now. When the market is in a state of extreme fear, it's often a sign of capitulation, where even the strongest hands start to doubt their positions and sell. This sentiment is amplified by social media and news headlines. You see endless articles with scary titles, and it creates a negative feedback loop. Fear leads to selling, which leads to lower prices, which leads to more fear. It's a psychological battle as much as it is a financial one. However, it's also worth noting what some contrarian investors say. The time of maximum fear can often be the time of maximum opportunity. Legendary investors like Warren Buffett have famously said to be fearful when others are greedy and greedy when others are fearful. While that's not financial advice, it's an important perspective to consider when evaluating market sentiment. Right now, fear is the dominant emotion, and it's a powerful driver of the current price action. Okay, so with all that doom and gloom, is there any reason to be optimistic? Let's look at the historical context. Bitcoin is no stranger to volatility. We've seen major corrections in bear markets before. In 2017, after its massive run-up, it experienced a brutal drop of over 80%. We saw similar large-scale corrections in other cycles too. What's important to note is that after each of these major downturns, Bitcoin has eventually recovered and gone on to set new all-time highs. The key is patience. These cycles are a natural part of a new asset class finding its footing. Each cycle also tends to bring in new waves of adoption. Technological improvements like the Lightning Network and a stronger, more resilient network, we're seeing continued institutional interest, not just in buying Bitcoin, but in building the infrastructure around it. Major financial firms are still developing crypto products and services. This long-term building phase often happens quietly during bear markets, laying the groundwork for the next bull run. So while the short-term price action can be scary, zooming out and looking at the bigger picture shows a consistent pattern of growth and resilience over the last decade. So, what does this all mean for you? The big question on everyone's mind is, what should I do now? First and foremost, this is not financial advice. You should always do your own research and make decisions based on your personal financial situation and risk tolerance. However, here are some general strategies that experienced investors often consider during times like these. One popular approach is dollar cost averaging, or DCA. This means investing a fixed amount of money at regular intervals, regardless of the price. By doing this, you average out your purchase price over time. When the price is low, your fixed amount buys more Bitcoin, and when it's high, it buys less. This strategy removes the emotion from trying to time the market, which is nearly impossible to do consistently. Another key principle is to have a long-term perspective. If you believed in the fundamental value of Bitcoin when the price was high, has that fundamentally changed just because the price has dropped? For many long-term believers, these downturns are seen as opportunities to accumulate more at a discount. And finally, it's crucial to only invest what you can afford to lose. The crypto market is volatile, and you should never put yourself in a position where a price drop could jeopardize your financial well-being. As we wrap up, let's summarize the key takeaways. The recent Bitcoin price drop isn't due to one single thing, but a perfect storm of several factors. We have macroeconomic pressures from rising interest rates creating a risk-off environment. We have regulatory uncertainty causing investors to be cautious. On-chain data showed large players moving coins to exchanges, signaling an intent to sell, which was then amplified by a cascade of liquidations in the derivatives market. And all of this is wrapped in a thick blanket of market fear, fueled by scary headlines and social media panic. However, looking at Bitcoin's history, these kinds of corrections are part of its DNA. The network has survived and thrived after every previous bear market, emerging stronger each time. The long-term adoption and development trends are still pointing upwards. What happens next is anyone's guess, but understanding these different forces at play is the first step to navigating this market wisely. Keep learning, stay informed, and think long-term. Thank you so much for sticking with me through this deep dive. I know it was a lot of information, but hopefully it brought some clarity to a very confusing situation. What are your thoughts on the current market? Do you think we've hit the bottom, or is there more pain to come? Let me know your opinions in the comments below. I read all of them and love hearing from this community. If you found this video helpful, please give it a thumbs up and consider subscribing to the channel for more content like this. Don't forget to hit that notification bell so you won't miss our next update. Stay safe out there, and I'll see you in the next video.